Let's talk stocks. Ron, whether it's an industry or a specific stock, what do you think is poised for upside this year?
So industry I'm looking at, it's kind of a sector / industry, and I'm not ready to call the big R word yet, the recession. I'm not freaking people out yet, but I think it's important
You are a little bit just by saying that.
I think it's important to have some allocation to some defensive stocks in the environment that we may be approaching. And so when I think of companies in those sectors, I would say some utilities might be a good bet right here. Some of the discounters, in fact, discount retailers, Costco, Dollar Tree, Walmart would be some nice stocks, defensive stocks to have as we enter an economy that might not be as robust as it has been.
What about you, Jason?
Yeah, as far as, I don't want to time when a recession might hit, because really that's just bad for everybody. But I do think we are entering a period where banks are going to have some opportunities to boost their earnings a little bit as interest rates continue to nudge upward. And in particular, I'm looking more at small banks, and one we've talked about before, Ameris Bancorp. I think this stock has a tremendous risk-reward scenario playing out here. The stock is now trading around 15 times earnings. They recently announced this merger with Fidelity Bank in Georgia. It's about a $750 million deal. And given that Ameris is about a $1.5 billion company, you can see it means a lot. The market rightly sold the stock off because I think there's some skepticism there. That's rolling in a big acquisition, but they are two very similar cultures. It gives Ameris tremendous exposure to the valuable Atlanta market, and it also is going to help grow that asset and deposit base, particularly in a period where a lot of these banks are really competing now for getting those deposit bases. So to me, this could play out kind of like the McCormick thing, right? Remember when McCormick acquired RB Foods and the market thought, whoa, this is a big one to digest here, and they kind of held off for a couple of quarters to see how things worked out. Lo and behold, it worked out pretty well, and the stock recovered nicely. I think we could be looking at the same thing here with Ameris if they execute this acquisition well. So,
Ron, if defensive stocks have you interested, what's at the other end of the spectrum? What are you avoiding this year?
Specifically, I have one stock in mind, and I come back to it often, and it's Fitbit. And I really have never been excited and probably will never be excited about this one. Now, they entered the smartwatch market in 2018, and I give it to them. They've done pretty well, but this is a formidably competitive market with the likes of Apple, for one, right there behind them. And you even have some Chinese upstarts that really could be a problem as well. I don't see Fitbit being the company that is constantly able to innovate, either take market share or defend market share, and I'd be real careful about this one.
What about you, Jason?
Yeah, I think Zillow, to me, is one that I've changed my tone on this company a bit over the past year. And I used to be excited about the potential there, and I feel like they have just failed to convince me of the sustainability here. They're yet to really become meaningfully profitable at all. And now in this most recent quarter, they put in their shareholder letter that Zillow Group has entered a period of transformational innovation. And to me, that is code for we're not going to be profitable anytime soon. And for a company like this, that company's been around for a while and such a big market opportunity as our housing market, they should not be entering this period. They should be coming out of this period, because I think that's what they were trying to do over these past few years. This instant offers business, it's not up their alley. I mean, that's buying homes and renovating them and selling them. It's not scalable. There are a lot of people out there doing it. I don't know that they have any real advantage there. Goodwill now represents essentially half of the total assets on the balance sheets. It's not a bad company. I'm disappointed in the way they've executed, and I think they've still got a ways to go before they get to meaningful profitability.
Well, I think one of the things that ties these two businesses together, Fitbit and Zillow, is the word optionality has been used in connection to both of these businesses. They were seen as, well, they have options in terms of where they can go. And optionality is something we like to see as investors. But Ron, it almost seems like optionality only works if you've got, or it certainly works better if you've got one dependable cash cow in your portfolio.
You nailed it, right? Optionality is great for additional upside, and maybe you can't even see the different options that a company might have 3 to 5 years down the road. But if they don't have that profitable company, that cash flow division, that cash flow producing segment of the company, then optionality, you're relying on all of the value of that company being in the optionality category, and that's just too much risk for me.